Listen, what's happening right now in the gold and silver markets is something most people completely miss. They see Friday as just another day, another market close, another weekend coming up. But if you understand what's really going on behind the scenes, you realize that Friday isn't just important. It's the single most critical day of the entire trading week, and I'm going to show you exactly why. Let me paint you a picture. It's Thursday night. You're watching the news, scrolling through your phone, maybe checking your portfolio. Gold's been moving, silver's been volatile, and you're wondering what's next. Then Friday morning hits. The markets open, and suddenly there's this energy, this intensity that wasn't there on Monday or Tuesday or Wednesday. Volume spikes. Price swings get bigger. And by the time that closing bell rings at 4 p.m. Eastern, fortunes have been made and lost. But here's what they don't tell you on CNBC. Here's what the mainstream financial media conveniently leaves out. Friday isn't just busy because people are wrapping up their week. Friday is critical because of what expires. Every single week, billions of dollars in options contracts reach their expiration date, and 4 times a year, on the third Friday of March, June, September, and December, we get what's called quadruple witching. That's when stock index futures, stock index options, single stock futures, and single stock options all expire on the same day. Think about that for a second. Trillions of dollars in derivative contracts all settling at once. The most recent one just happened. And when that much money is on the line, when that many positions need to be closed or rolled over, the market doesn't just move, it convulses. We're talking about institutional players, hedge funds, market makers, all scrambling to manage their exposure. And in that chaos, in that volatility, gold and silver react in ways that can catch retail investors completely off guard. Now you might be thinking, okay, but I don't trade options. Why should I care? And that's exactly the mindset that keeps people on the sidelines while the big money makes its moves. Because even if you're not trading options yourself, the people who are trading them are moving the markets you're invested in. They're creating the volatility that either protects your wealth or destroys it. And if you don't understand the game they're playing, you're just a spectator watching your account balance swing wildly without knowing why. Let me take you back to a specific Friday. It was the third Friday of a recent quarter, quadruple witching day. The morning started relatively calm. Gold was trading around its usual range, silver was doing its thing. But as the day progressed, something interesting happened. Around 2 p.m., just 2 hours before the close, gold suddenly dropped. Not a little dip, a significant move down. Panic selling? Maybe. But more likely, it was institutional players closing out positions, hedging their bets, making sure they weren't caught on the wrong side when those contracts expired. Then, in the final hour, gold reversed. Shot back up. Why? Because once those options expired, once the pressure was off, the real demand showed itself. The physical buyers who had been waiting on the sidelines stepped in. The smart money that understood the game bought the dip. And by the closing bell, gold had recovered most of its losses. But here's the kicker. If you panicked during that 2 p.m. drop, if you sold thinking the sky was falling, you locked in your losses right before the recovery. You played right into their hands. This happens every single Friday, just on different scales. The third Friday of each quarter is the big one, but every Friday has options expiring. Every Friday has this dynamic playing out. And the people who understand this, the people who know how to read these moves, they're the ones consistently making money, while everyone else is confused and frustrated. Now let's talk about why this matters even more for gold and silver specifically. These aren't just stocks. They're not just commodities. They're monetary metals. They're insurance against currency debasement, against inflation, against the kind of economic chaos that keeps central bankers up at night. And because of that, the options market for gold and silver is absolutely massive. We're talking about the COMEX, the world's largest precious metals futures exchange, where billions of dollars in gold and silver contracts trade every single day. Here's where it gets really interesting. The COMEX operates on a fractional reserve system. That means for every ounce of physical gold or silver in their vaults, there are multiple paper claims on that same ounce. Some estimates put it at 100 to 1 or even higher. So when options expire on Friday, when contracts need to be settled, the question becomes, who's actually taking delivery of physical metal and who's just rolling their position into the next month? Most of the time, it's the latter. Most traders don't want physical gold or silver. They're just speculating on price movements. They're happy to settle in cash or roll their contracts forward, but every now and then, someone calls their bluff. Someone says, I want my metal. And when that happens, when physical delivery is demanded, The whole house of cards starts to shake. There was a period not too long ago when this exact scenario played out. A major player started taking delivery of physical silver from the COMEX. Week after week, month after month, they kept demanding the actual metal, and the COMEX had to scramble. They had to find the silver, ship it out, and hope that not too many other people got the same idea. Because if everyone who held a paper claim suddenly wanted their physical metal, the system would collapse overnight. There simply isn't enough to go around. This is why Friday matters so much. It's the day when the rubber meets the road. It's when paper promises either get fulfilled or rolled forward. And the price action on Friday, especially in those final hours of trading, tells you everything you need to know about the real supply and demand dynamics in the market. Let me give you another example. Think about a Friday when a major economic report drops. Maybe it's the jobs report, maybe it's inflation data, maybe it's a Federal Reserve announcement. These reports often come out on Friday mornings, and when they do, the market has to digest that information and react, all while knowing that options are expiring that same day. The combination creates explosive volatility. Say the jobs report comes out stronger than expected. The immediate reaction might be that the Fed won't cut rates as aggressively, which is supposedly bad for gold. So gold drops. But then, as the day goes on, traders start thinking deeper. Stronger jobs mean more inflation pressure. More inflation means the Fed is trapped. They can't raise rates without crashing the economy, but they can't cut rates without letting inflation run wild. And in that scenario, gold is the ultimate winner. So by the afternoon, gold is rallying again. And all of this is happening while billions in options are expiring, adding fuel to the fire. The people who make money in this environment aren't the ones reacting emotionally to headlines. They're the ones who understand the structure of the market. They know that Friday morning volatility is often a head fake. They know that the real move happens in the afternoon, after the weak hands have been shaken out. They know that options expiration creates artificial pressure that doesn't reflect true supply and demand. And here's something else most people don't realize. The big institutional players, the ones with billions under management, they're not just passive participants in this Friday drama. They're actively managing it. They're using options to hedge their positions, to amplify their gains, to protect against downside risk. And in doing so, they're creating the very volatility that retail investors find so confusing and scary. Think about it like this. If you're a hedge fund with a massive long position in gold, you might sell call options to generate income. But as Friday approaches and those options are about to expire, you need to manage your risk. If gold is trading above your strike price, you might need to sell some of your physical position to avoid getting assigned. That selling pressure pushes the price down, but once the options expire, once that pressure is relieved, the price can bounce back. It's a self-fulfilling cycle, and it happens every single week. Now, I want to pause here for just a second because this is important. If you're sitting on a significant amount in retirement accounts, let's say $100,000 or more, and you're concerned about this kind of volatility, about protecting your wealth in an environment where the rules seem rigged against the little guy, I've put together a free guide on how gold IRAs work. It's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties, how to navigate the process, and what to watch out for. It's worth checking out if that's relevant to your situation. All right, back to what's happening on Fridays. So we've established that options expiration creates volatility. We've established that institutional players are managing their positions in ways that move the market. But there's another layer to this that makes Friday even more critical, and it has to do with the weekend effect. When the market closes on Friday afternoon, it doesn't reopen until Sunday evening for futures trading, and Monday morning for regular trading. That's roughly 60 hours where anything can happen in the world, but the market is frozen. A geopolitical crisis could erupt. A central bank could make a surprise announcement. A major financial institution could fail. And traders know this. They know that holding positions over the weekend is risky. So what do? They adjust their positions on Friday. If they're nervous about the weekend, they might reduce their exposure, which creates selling pressure. If they think something big is coming and they want to be positioned for it, they might add to their positions, which creates buying pressure. Either way, Friday becomes the day when traders are making their final bets before the weekend uncertainty. And this weekend effect is even more pronounced in gold and silver because these are the ultimate safe haven assets. When geopolitical tensions rise, when financial markets get shaky, when currencies start to wobble, gold and silver are where people run for safety. So if there's any hint of trouble brewing over the weekend, you'll see it in the Friday price action. Gold will rally, silver will spike, and by the time Monday rolls around, the move has already happened. The people who waited until Monday to react are too late. Let me tell you about a specific Friday that perfectly illustrates this. It was a few years back, and tensions were escalating in the Middle East. Nothing had happened yet, but the rhetoric was heating up, and everyone knew the weekend could bring news. On that Friday morning, gold was trading relatively flat. But as the day went on, as traders started thinking about the weekend risk, gold began to climb. By the afternoon, it was up significantly. And sure enough, over the weekend, a major incident occurred. When the market opened on Monday, gold gapped up even higher. But the people who made the real money were the ones who positioned themselves on Friday. They understood that the weekend risk premium was real, and they acted accordingly. This is why you can't just look at gold and silver prices in isolation. You have to understand the context. You have to know what day of the week it is, what's expiring, what events are on the horizon. Friday isn't just another day. It's the day when all of these factors converge, creating opportunities for those who understand the game and traps for those who don't. Now, let's talk about the bigger picture. Why does all of this matter beyond just making short-term trading profits? Because the Friday dynamics I'm describing are a microcosm of what's happening in the broader financial system. The options market, the derivatives market, the paper gold and silver market, these are all built on leverage, on promises, on the assumption that not everyone will demand settlement at the same time. But what happens when that assumption breaks down? What happens when a critical mass of people decide they want physical metal instead of paper promises? What happens when the COMEX can't deliver? When the fractional reserve system is exposed for the house of cards it is? That's when the real price discovery happens. That's when gold and silver go from being volatile trading vehicles to being the only assets that matter. And here's the thing. We're seeing signs that this breakdown is already beginning. Central banks around the world are buying physical gold at record rates. They're not buying paper gold. They're not buying ETFs. They're buying bars, taking delivery, and storing them in their own vaults. Why? Because they know what's coming. They know that when the next crisis hits, when the next financial panic erupts, paper promises won't be worth anything. Only physical metal will matter. The same thing is happening with wealthy individuals and family offices. They're quietly accumulating physical gold and silver, taking it out of the system, storing it in private vaults. They're not waiting for Friday's options expiration to make their moves. They're thinking in terms of years and decades, not days and weeks. But their actions are creating a slow-motion squeeze on the physical market that will eventually show up in the price. And when it does, when the paper market finally breaks and price discovery shifts to the physical market, those Friday dynamics we've been talking about will seem quaint. The volatility we see now will look like nothing compared to what's coming. Because when the system breaks, when confidence is lost, the scramble for physical metal will be unlike anything we've seen in modern times. Think back to previous moments of financial crisis. In 2008, when Lehman Brothers collapsed and the financial system was on the brink, what happened to gold? It initially dropped as everything was sold to raise cash, but then it rallied hard as people realized that the entire system was built on sand. In 2011, when the European debt crisis was raging and the US was getting its credit rating downgraded, gold hit all-time highs. And in 2020, when COVID hit and central banks started printing money like there was no tomorrow, gold surged again. Each time, the pattern was the same. Initial volatility, confusion, panic selling. Then a realization that the traditional financial system couldn't be trusted. Then a rush into gold and silver as the only real money, the only assets that don't depend on someone else's promise to pay. And each time, the people who made the most money weren't the ones reacting to the headlines. They were the ones who understood the structure of the market, who knew how to read the Friday price action, who could see through the short-term noise to the long-term trend. They were the ones who bought when everyone else was selling, who held when everyone else was panicking, who understood that volatility is the price you pay for being positioned in the right assets at the right time. So when I tell you that Friday is the most important day of the trading week, I'm not just talking about short-term trading opportunities. I'm talking about understanding the mechanics of the market, the forces that drive price action, the difference between paper and physical, between speculation and real demand. I'm talking about positioning yourself not just for the next week or the next month, but for the next phase of the financial system. Because here's what's really happening. The current system, the one built on fiat currency and unlimited money printing and fractional reserve everything, is reaching its limits. The debt levels are unsustainable. The inflation is undeniable. The loss of confidence is accelerating. And when the system finally breaks, not if but when, the people who understood these Friday dynamics, who understood the difference between paper and physical, who positioned themselves accordingly, they're going to be the ones who preserve their wealth and come out ahead. Every Friday, the market is giving you clues. It's showing you where the pressure points are, where the leverage is concentrated, where the real demand is versus the paper speculation. Most people ignore these clues. They see the volatility and get scared. They see the price swings and get confused. They don't understand why gold can drop in the morning and rally in the afternoon, why silver can be smashed down one week and explode higher the next. But now you know. Now you understand that Friday isn't random. It's structured. It's predictable in its unpredictability. It's the day when the paper market shows its hand, when options expire and positions get adjusted and the weekend risk premium gets priced in. It's the day when the smart money makes its moves while the retail crowd is still trying to figure out what's happening. And the beautiful thing is, once you understand this, once you see the pattern, you can't unsee it. Every Friday becomes a window into the real dynamics of the market. Every options expiration becomes an opportunity to see where the pressure is building. Every weekend becomes a reminder that the system is more fragile than most people realize. So what do you do with this information? How do you position yourself to take advantage of these Friday dynamics while protecting yourself from the bigger risks in the system? First, you stop reacting emotionally to short-term price moves. You understand that Friday volatility is often manufactured, that it doesn't reflect true supply and demand. You use that volatility to your advantage, buying when others are panicking, staying calm when others are confused. Second, you focus on physical metal, not paper promises. You understand that when the system breaks, when the COMEX can't deliver, when the ETFs are exposed as fractional reserve schemes, only physical gold and silver will matter. You take delivery, you store it securely, you treat it as insurance against the kind of systemic risk that keeps getting bigger with each passing week. Third, you pay attention to what the smart money is doing. You watch central bank buying. You track institutional accumulation. You notice when major players start taking delivery from the COMEX. These are the signals that matter, not the daily noise on financial television. And fourth, you think long-term. You understand that these Friday dynamics are just the surface level of a much deeper transformation happening in the financial system. You position yourself not for the next trade, but for the next era. Because when this current system finally gives way to whatever comes next, the people who understood what was really happening, who positioned themselves in real assets instead of paper promises, they're going to be the ones who thrive. Friday is the most important day because it's when all of these forces converge. It's when the paper market meets reality, when speculation meets settlement, when leverage meets delivery. It's when the game is played at its highest level, and the people who understand the rules have a massive advantage over those who don't. So the next time Friday rolls around, the next time you see gold and silver moving in ways that seem confusing or random, remember what's really happening. Remember the options expiring, the positions being adjusted, the weekend risk being priced in. Remember that behind every price move is a reason, a structure, a game being played by people who understand these dynamics far better than the average investor. And most importantly, remember that this isn't just about making money on short-term trades. It's about understanding the fragility of the current system, the inevitability of its transformation, and the critical importance of being positioned in real assets when that transformation accelerates. Friday is the most important day because it's a weekly reminder that the system is built on paper, on promises, on leverage that can't be sustained forever. And when it finally breaks, when the Friday volatility becomes a permanent state of crisis, the people who understood what was really happening will be the ones who preserved their wealth and came out ahead. The clock is ticking. Every Friday that passes is another week closer to the moment when the paper market breaks, and physical metal becomes the only thing that matters. The question isn't whether you'll be ready. The question is whether you'll understand what's happening in time to position yourself accordingly. Because once the break happens, once the system loses confidence, there won't be time to react. The people who waited will be left scrambling, while the people who understood these Friday dynamics, who saw the writing on the wall, who positioned themselves in physical gold and silver, they'll be watching from a position of strength. That's why Friday is the most important day. Not because of what happens on any single Friday, but because of what every Friday is telling you about the state of the market, the fragility of the system, and the opportunity that exists for those who understand the game being played. Pay attention. Learn the patterns. Position yourself accordingly. Because the next phase of this story is going to be unlike anything we've seen before. And the people who are ready will be the ones who thrive.